If you think back to the lead up to the 2008 financial crisis, it kind of felt like getting a mortgage was the Wild West. Some of the loan terms were, well, let's just say creative. That whole era of super risky lending led to a massive crisis. And out of that wreckage, a whole new set of rules was built to make sure it never, ever happened again. So today, we're going to look at those rules, the guardrails designed to keep your home loan on a safe and steady path. Okay, let's get into it.
So yeah, this is the big question, right? Before all these new rules, the honest answer was sometimes. Not a whole lot. But after the crisis, a law called the Dodd-Frank Act came along and created a really simple but incredibly powerful new standard. Lenders have to make sure you can actually afford the loan they're giving you. Now that sounds like total common sense, I know, but believe me, it was a massive change for the entire industry.
Here's the game plan for our explainer. First, we'll tackle the foundational rule that every lender has to follow now. Then, we'll look at what's considered the gold standard for a safe loan. And finally, we'll dig into two special categories of loans that basically come with bright yellow warning labels and extra protections for you, the homeowner.
All right, first up, let's talk about the absolute bedrock of modern mortgage lending. This isn't just a friendly suggestion for lenders. This is the law, plain and simple. So, this rule, the Ability to Repay Rule, or ATR for short, it basically says a lender can't just glance at your credit score and say, yeah, looks good, and call it a day. No way. They have a legal responsibility to do their homework and prove, in good faith, that you have the financial chops to handle those mortgage payments for the long haul.
And what does that homework actually look like? Well, it means they have to verify all of these key pieces of your financial life. They need to look at your income, your assets, confirm your employment, check your credit history, and, this is a big one, see how that new mortgage payment is going to fit in with all your other debts, like car payments or student loans. It's all about building a complete, documented financial picture to justify giving you the loan.
Okay, so if the ability to repay rule is the law, then you can think of a qualified mortgage as the most direct, straightforward way for a lender to prove they followed it. This is what's known as the safe harbor for lenders, and it's a really important concept.
A qualified mortgage, or QM, is basically a loan that's built for safety. It checks all the right boxes and avoids a lot of the risky features that got people into trouble before. And because of that, if a lender gives you a QM loan, they get this legal protection, this safe harbor, where they're basically presumed to have done their job and followed the ability to repay rule. This gives lenders a huge incentive to offer these safer, more stable loans, which, of course, is great news for you.
Now, what's really interesting here is what a safe loan isn't. A QM can't have things like interest-only periods, where your principal balance never goes down. It completely bans something called negative amortization, which is a crazy situation where your loan balance could actually grow even while you're making payments. And it sticks to predictable structures, terms of 30 years or less, and no giant surprise balloon payments waiting for you at the end. On top of that, it also has to be priced fairly.
And that's where this number comes in. For a loan to count as a qualified mortgage, the upfront points and fees the lender charges are generally capped at 3% of the total loan amount. This is a huge deal because it protects you from getting hit with excessive fees right out of the gate.
Okay, now we're moving into the warning light categories. I want you to think of these next two types of loans as the rumble strips on the side of the highway. If your loan starts to drift into this territory, a bunch of alarms go off, and some really important consumer protections kick in. First up, high-cost mortgages. These are also known as Hoepa loans. That stands for the Home Ownership and Equity Protection Act. Bit of a mouthful, I know. But this is a really serious designation for loans that are just way more expensive than the average loan out there. And the whole reason for slapping this label on them is to give you an extra layer of protection against potentially predatory lending.
That's the million-dollar question, isn't it? I mean, at what point does a loan officially cross that line and get this high-cost label? Well, the government is actually very, very specific about this.
For a typical first mortgage, this is the magic number you need to remember: 6.5%.
So here's what that actually means. Regulators keep track of something called the average prime offer rate. Just think of it as the average interest rate that folks with great credit are getting. If the annual percentage rate, or APR, on your loan is more than 6.5 percentage points above that average, then boom, it is automatically considered a high-cost Hoepa loan, and all those alarms start ringing.
And the second a loan gets that high-cost label, these protections kick in. Lenders generally can't charge you a penalty for paying the loan off early, and those risky balloon payments are banned.
But most importantly, and this is a big one, before you can even sign the final papers, you are required to go through a counseling session with a government-approved counselor to make absolutely sure you understand the risks you're taking on.
Okay, on to our final category. Now this one is really easy to confuse with the last one, but it is a totally separate classification with its own rules. It's called a high-priced mortgage loan, and it's another one of those warning labels, but the triggers are different.
So, a high-priced mortgage loan, or HPML, is a loan that's more expensive than average, but it's not quite expensive enough to set off those super serious, high-cost Hoepa alarms. Think of it as a middle ground. It's not a red alert, but it's definitely a flashing yellow light, and that means some extra requirements are going to apply.
This slide really lays out the difference perfectly. For that same standard mortgage, the trigger for becoming high-priced is much, much lower. If your loan's APR is just 1.5 percentage points over the average rate, it gets flagged. You can see right away how that's a much more sensitive trigger than that big 6.5% hurdle for a high-cost loan.
So because these loans carry that yellow flag, lenders have to take some extra precautions. For one, they're required to set up an escrow account for your property taxes and homeowners insurance and keep it going for at least 5 years. This just makes sure those critical bills get paid. There's also this really smart rule to protect against inflated home values. A second appraisal might be required if you're buying a house that was just bought and resold or flipped for a much higher price.
So when you step back and look at the big picture, you can really see how all these rules fit together. The ability to repay rule, that's the road itself, the basic foundation for any loan. A qualified mortgage, that's the safe, smooth center lane. And those high-price and high-cost loans, well, those are the rumble strips and the flashing warning signs, letting both you and the lender know that you're getting close to the edge of the road.
This whole system, all these guardrails, were designed to prevent another financial meltdown by adding these layers of safety. But it does bring up a really big, important question. In the process of making mortgages safer for everyone, have we also made them harder to get for people who don't fit perfectly inside that traditional box? Finding that perfect balance between protecting consumers and making sure people still have access to the credit they need, well, that's the ongoing challenge at the very heart of the mortgage world today.